Good evening, folks. Thanks for joining us tonight. I think we had a little bit of technical difficulty. I think it's just we're a little rusty here. We haven't done a presentation since before the end of last year, so we appreciate you joining us this evening. Hope y'all can hear us and see us. So welcome to our education series call tonight. We've got a pretty good presentation for you tonight. This is the first in our education series. This year we're going to do a couple of different series. Amy, if you can just advance to the next slide there. There we go. This one is called, this initial series that we're starting with is called Selling My Veterinary Hospital. So what we're going to do for the next 3 months is bring you 6 individual sessions all around different topics on selling your veterinary hospital. Tonight, as we mentioned, we're going to talk about when is the right time to sell. You're going to hear from Dr. Ackerman here in a little bit, and he's got a lot of experience in selling veterinary practices and preparing those individuals to be sure that they're ready to sell. Second one in February is what the heck is EBITDA? I'm sure you all, if anybody's been involved in practice sales or talking to corporates about your practice, EBITDA becomes a very important part of the conversation. Also, hiring the right advisors. We're going to talk about March 9th. What kind of brokers do you need? What kind of advisors with regard to CPAs, accountants, any legal advice that you might need along the way. You can get some good help, and you can also get some bad advice too. So we'll help you kind of figure that piece out. Second, rounding out March, we're going to talk about what you should know about corporate buyers. They're not all the same. They've all got different tracks that they're on in terms of their growth, and we can help you kind of figure out which buyers might be a good fit. And then in April, we're going to start out with the sales process, kind of what you need to know. How does the process work from start to finish? And then we'll finish up April kind of talking about the market and kind of what to expect with regard to multiples and demand. But should be an exciting series. We hope you can join us for as many as possible. We're looking forward to tonight's call, for tonight's meeting. Next slide, please. We do want this to be an interactive session if you can. So a couple of ways that you can interact with us and ask questions tonight. There's a Q&A button on your screen, the bottom of your screen. You can simply click on that button and type your question, and we'll try to get to it throughout the presentation. If you want to ask your question in person, please do. We encourage that. There's a little hand button there that you can press, and we'll see that. And we'll unmute you. Everybody is muted for the benefit of the audience here tonight. So we'll unmute you and you can ask your question, or you can just send us your question in the chat function. So we will have a couple of opportunities throughout the presentation to ask questions, but feel free at any time to pop a question over and we'll get it answered. So I mentioned tonight's topic is when is the right time to sell? And you're going to hear from Gary in just a minute. Before we dive in there, I just wanted to give you a little bit of background on us and the Ackerman Group, if, for those of you that aren't familiar with who we are. Next slide there, Amy. In the last 4 years, we have actually sold a little over $750 million of veterinary practices to the corporate market. That is all we do, is we sell veterinary practices and work with corporations to find the right fit. We don't do vet-to-vet sales. We're strictly in the corporate market, and have had quite a bit of success over the last 4 years. We've helped about 135 veterinarians transition their hospitals. In that time period, we really kind of become known as the industry leader in customized practice sales, transitions, and advice. So really think we're in the right space at the right time. Dr. Ackerman, as you'll see when you hear him talk this evening, has just a lot of experience, been in the business for over 30 years, and brings a lot to the table when you start thinking about transitioning your practice. Just a little bit about our model for success. The Ackerman Group, we kind of take a little bit different approach, kind of a 3-pronged approach to helping you transition from, veterinary practice to possibly retirement or even a minimal role in your practice. And it's really just kind of three legs of the stool. The first one is, go ahead, Amy, next slide there. You got to hit it twice, sorry. Yeah, we'll get this straight before we come up with our next presentation here. So the first leg of that stool and the model for success is the best fit. It's really the best, trying to find the best cultural fit for you and your practice. A buyer that's going to come in and kind of mesh with your computer systems, your lab systems. They're not going to change a lot with regard to the way you practice medicine. We kind of think this is probably one of the most important factors when you consider selling your practice or trying to find the right fit, the right corporate buyer. If you don't have the right fit, the right price is probably not going to make up the difference. So we really feel that's probably one of the most important factors. And then secondly is the terms. These are extremely complicated transactions. There are, things that need to be negotiated, from everything from the purchase and sale agreement to your employment agreements for yourself and for your associates, as well as real estate terms and lease arrangements that need to be negotiated. So again, the right partner with the right terms can really make or break a deal. And we think that's equally as important as finding the right fit. And then lastly, the price. Obviously, everybody's pretty well concerned about price. Sometimes you start thinking about price maybe a little bit early. It probably is maybe one of the reasons that some of you are on this call. You've heard from corporate buyers, and a lot of pretty big prices are being thrown around, but it certainly is not all about price, but price is certainly important. If you can fit the first two pieces of the stool together and come in with the right price, Gary will tell you in our conversation this evening that we probably, in a lot of cases, don't necessarily sell or transact with the highest price. The terms or the fit might be more important than that last few $1,000s of price. So very important, but we certainly need to attempt to bring all three of those to have a successful transaction. So that's our model for success. It is best fit, best terms, best price. So that's a little bit about us. I'm going to stop talking now. I know you didn't log in to hear me, so I'm going to turn the presentation over to Gary. Gary, tell us a little bit about your background, and let's talk a little bit about when the best time to sell might be.
Jeff, thanks very much, and it's really good to be getting these conversations going again for the start of the new year here. We're excited about this 6-part series. This is the first time we've really done any type of series of discussions about how to do a transaction and how to get your practice ready. The first thing, before I even get into myself, I'm looking at the list of people that are attending. We've got almost 60 people on the call. There's just a wide diversity of people coming on this call. We've got owner veterinarians, associate veterinarians, industry people, advisors, and we put out there, and all these calls are on our website, what we think about what's going on in the market, and we're really happy that other people are coming in and listening. We get feedback from these. That's really how we do a better job for everybody. We listen to the questions that everybody wants to know the answers to, and we get feedback from the different companies and the different advisors as to what's working on the transactions for them. And we're trying to make it as much public knowledge as we can. So thanks for everybody to be in here. It's just good educational background for it. As far as my background, I came from where a lot of you are. I own multiple practices in my life. I was a owner for 20 some years, and that really gave me the initial background into veterinary medicine and understanding the transition approach. And I sold my practices in 2001. I actually thought I would be doing some additional veterinary practice ownership when I did so, and just happened to go off on a tangent doing advising and brokering practice sales on the side, and my sideline got busy. I never ended up going back to owning practices, and it's been a lot of fun over the last 20 years. We've worked with I mean, hundreds of veterinarians doing different types of exit strategies. Started out doing 1031 exchanges on the real estate, the veterinary real estate, which is a tax deferred position. Ended up doing investment management for veterinarians that were selling their practices, and we were creating these lump sum payouts, and they needed to invest it. So I was a licensed financial advisor for many years, and it was from literally doing the real estate portion and the financial advising that we got into doing the brokerage, because we had all these people coming in the door that had needed advice on it sooner than we were coming to help with them. We'd usually get to them after the transactions are occurred, and it became pretty obvious over time they needed some advice before the transactions were occurring. And so I phased out of doing most of the majority of that stuff. I'm not doing any of the financial advising anymore. We're still doing a fair amount of tax work because a lot of these transactions are, have issues associated with that. So what we're trying to do is put things together in a manner that makes a lot of sense. These are, more than anything, what we're trying to do is have everybody adopt a holistic approach to this, because practically speaking, this is an integration of what you're doing in the both your business and your personal planning. It includes your financial planning, some legal planning, some tax planning, potentially estate planning. What you're doing is you're taking many different approaches literally at the same time when you're doing a planning of a practice sale transaction. And so, what I want to emphasize to everybody is that we're going to talk about 2 or 3 different things that need to be ready in this discussion today. And as you go through the process, you're going to be doing all of these. You should be doing all of these to get the most complete type of transaction. That's the first thing I wanted to chat with you about, is just, this is a holistic approach. So what I would ask you in trying to determine when is the right time to sell, is the first thing I would ask you is, are you ready personally? This is a personal transaction, and so you need to understand where you are in your personal timeline. And so we'll talk a little bit about that if we can go to the next slide. So, the first question is not about your practice. The first question is about each of you. Are you ready? Do you see what what things are going to look like in 3 to 5 years? Because when we talk to people about their practice, we're pulling in financial information and things like that on your practice, but we are absolutely talking about what you want out of this transaction for both you, for your staff, for your associate doctors, for your clients. These are all things that you need to be considering. And so we kind of start out just conceptually as, what do you see yourself doing, and how much are you going to be working, and where are you going to be working, or are you going to be working? Is the goal from doing a transaction to bring in partners, associates or outside companies to help, to exit your practice? Or do you want to decrease working? Do you want to decrease your management? Are you interested in doing more medicine or surgery or charitable work? These are all goals that we see from our clients when they're going into a transaction. And what we try to do is understand that. And I'm telling you, you should understand that, because in the current market where there's just such a tremendous amount of demand, figure out what you want to do and then try and go ask for it. That's the approach that we like to take. In that, you are going to be happier if you understand where you want to be in 3 to 5 years, and try and include that in the planning that you're doing. Do you have any other goals? Do you have any other wishes? Things like that. Because what's interesting is that we see a lot of clients of ours that we're several years past their transactions, and it's amazing to me watching what some of these people are doing, because we see things that are really very prevalent and core pieces of their life now that weren't even on their radar screen at the time that they were looking to sell. And it's kind of exciting to see that. It's interesting, and we see people that just have time to bloom. And so think about where you want to be conceptually, and try to ask for that and going out and doing your transaction. The other piece of it is, are you ready financially, personally? Not is your practice ready from a financial perspective, but are you personally ready? Can you sell and then transition into whatever it is that your goal is? Have you done a financial plan or a cash flow plan with some type of plan or anything on a post-sale basis so that you can kind of throw in some of the numbers that we might give you on an estimate on a sale price, and then understand what this is going to drop down to your bottom line, because at some point in time you're likely to be living to some degree off the proceeds from this transaction. It tends to be one of the bigger financial transactions in the lives of our sellers, and so it's very, very material, and it's material for you to get help and do it right, but also understand what it's going to do for you financially. Because maybe 20% of the people that we talk to, either they are not ready personally, or their practice is not ready from a financial perspective to create the assets that are needed on an after-tax basis to fund what they need for retirement or whatever it is that they're looking for. I've been the bearer of this news on many, many occasions, because we've crunched numbers for people and had some ideas as to what they needed to net out of transactions, and we're just not there. Either the requirement that they need to net has not been met by the practice sale and their savings, or the practice hasn't grown enough, or multiple different things along that line. But just make sure that your personal asset accumulation outside of the practice has occurred to a reasonable position, that you're going to have some income coming in from the practice sale, maybe some real estate income down the road from real estate on the practice or other outside real estate. Just understand what life is going to look like on the other side. Where we kind of assist in this, we're doing mostly corporate transactions. We've had multiple situations where we've been the bearer of the news that you have two choices. You can do a corporate sale at a higher valuation, which is where they are now, or you can work 5 more years. What do you want to do? That's where you are. And so we will help people discern some of the differences in valuation on sales on the corporate market versus sale on through a regular broker to another veterinarian or to associates or things along that line. And a lot of that is just time and putting in some more years to get some greater distributions, or getting a higher sale price. Take your pick. The other piece on it that really never hits any of the documents, it's not going to hit our financial metrics on your practice when we go and do an assessment of your practice or an evaluation. It's not going to hit your letter of intent or your asset purchase agreement or your legal documents or anything like that. Are you emotionally ready to sell? Okay. I mean, this is just, there's going to be so many emotions that go through when you're doing these types of transactions that you just got to be aware that it's going to be a little bit of an emotional roller coaster also. Besides the fact that you're taking your practice baby and putting it out there to the market and saying, what do you think? And you certainly get metrics on what people think about it. There's going to be change that's going to occur. And granted, the majority of the companies say that they're not going to try not to change anything. We're trying to keep your practice culture, and to a degree, I think they do. But the flip side is that no matter what you think is going to happen, it's actually going to be a little bit different than what you perceive. People are going to take it slightly different than you might think. What's going to change might be different than you think. There is going to be some change associated with this, and the reality is, change is a thing that makes people have some fear or some trepidation or whatever you want. And so, my sentiment is just be aware that this is going to be a change for your practice for more than you. Okay. And so there's going to be lots of people that have emotions about this, and you're going to have a lot of options, things along that line. Just make sure that you that you're prepared for this to be a little bit of a up and down process. I mean, it's a roller coaster, because you get into the middle of it and you get excitement over what your practice valuation is, and then you hit the wall when you see what the tax bill is, and then some legal issues crop up or some associate issues crop up. The areas of concern that we see that really cause a lot of emotional angst is telling what you're doing to your staff and your associates and your clients. Man, there's so much hand wringing over that we see all the time. We also see a lot of kind of control freaks that are owners of veterinary practices. Imagine that you want to do what you want to do in your own practice, and you're sitting here considering giving up that position, but still likely being there for a couple of years. After owning for 20 years or 30 years, that feels really good. And so there's you're adapting to a little bit slightly different role. Many of you have various levels of personal perks. We see, all kinds of kids being employed and cars and, various things that are, that are quasi business expenses that they're going to go away. And, people get kind of a little bit concerned about what happens to all these benefits that I might have been getting. You also might lose a little bit of your position in the community. You may not any longer be, if you're in a community you're really well known, you may not be as well known. So all of these are things that are emotionally will take a toll on you. And the only thing I would say is this is a transaction to just be aware of what you're getting yourself into, to position yourself really well in advance of it, but realize that it's both the practice and you personally and the other people affiliated with the practice and all of these advisors that you're integrating with, your financial planner and your attorney and your CPA. All of these are going to be, they're going to come in and they're going to have an effect on this transaction. They're going to help you do it, but you're going to be interacting with all of them. And it's just a lot of stuff that you go through that is not part of your day-to-day normal life right now. So that's kind of the personal piece on it. Before I get to is your practice ready, which is my next slide. Any questions? Anybody had any thoughts about that?
Hey, Gary, I just maybe had a comment maybe before you move to the next slide, just really about that sort of that financial planning. What sort of questions would would someone considering selling their practice, what would they be asking their financial advisor? I mean, is it all about the taxes, or what are the kind of questions they want to ask?
So the taxes are generally, and I'll talk about that in just a little bit too. The taxes are generally the CPA more than the financial advisor. We want to make sure that the options for doing things in different manners, with how they will affect the taxes, because that'll drop to your bottom line. The biggest thing that I see short term with the financial planners is doing some type of modeling on a cash sale versus a retained interest in a joint venture where you keep a part of the practice, or where you invest in the private equity, and you're investing in the parent company that might be buying you. These have huge impacts to your bottom line on a net worth basis over 5, 10, 15 years. And so a lot of what I'm doing with people that we're integrating with their financial planners at the time of a sale is going over how the different options that they have to sell their practice influence their financial plan. That's a key place, and we've got some pretty good metrics on the net result of a bunch of those different types of transactions. And so you might be trying to decide, do you sell 100% of your practice, or do I keep 40% of it as a joint venture and continue to get cash flow for the next 2 or 3 years and then sell it at a higher number? And how does that drop it down into your financial plan? The other thing that we see is we do see some spinoffs occasionally to kids or things like that, especially with potential tax changes coming forward and stuff like that. We've certainly seen some desire to get some of the assets out of the individual's names and into other names, into trusts, things along that line. Those are all things that can come up in the middle of this. And the reality is, we also see some planning needs because people haven't fully planned out, trusts and estates or wills or things along that line, and your situation is changing. If you sell the practice, you're a whole lot more liquid. Your assets are nowhere near as illiquid. It's not invested in a business. You have cash. You have other things along that line, and so that needs to be addressed because management of it is different than management of your business. Okay. On to the next one. So the question that comes up next is, is your practice ready? And so I would tell you that there's a couple things you should know. I mean, you should absolutely know what your EBITDA calculation is on a tax basis, which is what you're seeing drop to your bottom line on your profit and loss, but also on a normalized basis for purposes of valuation. And those are going to be completely different. We have I think one of our webinars on this series is going to be on EBITDA. What the heck is EBITDA? And we're going to be talking about that. And we've got some already on our website that talk about the same thing. But the bottom line is you need to have an understanding as to what your profit is for valuation purposes, because that is absolutely going to be one of the two things that directly affects what your practice will sell for. There's no question about it. I don't care what type of practice you have. it is going to be some reflection of your profit in the current market. So, I would tell you, have some idea where your margins are, and have some idea where your margins should be, or where they are and compared to what we're seeing on the market. And, Jeff will talk a little bit about the evaluations we do at the end of the webinar. But the reality is we look at that for people regularly. I mean, we're doing, 5 or 10 of these a week, and trying to have an understanding as to where people are, so we can give them some guidance as to is this is where you are, this is where the market is, this is where similar practices have sold for. Because for us, this is a tool to try and give you some reasonable estimate as far as valuation, because it directly transfers into that. So in order to do that and to make sure your practice is ready to transition, the first thing I would tell you is make sure that your financials and your practice data is really, really clean. We see what I see is 20, 30 years of management of a practice for tax purposes, and in that circumstance we see a lot of personalized expenses that are kind of run through the business, and that are some quasi business expenses, and let's just call it expenses that a buyer would not necessarily assume. And it could be your kids working for you, or over fair market value rent, or a car that's in the business, or somebody that does some work that goes elsewhere to do it, all kinds of different things that we see. My sentiment to you is make sure that you minimize this as much as you can in the 2 years or so before a sale, or if you don't minimize it, at least put it in a position that you can segregate it easily inside of your financial data, because ultimately we're going to go in and we're going to carve some of that out to get your normalized EBITDA. But the more detailed it is, so that we can do that easily, the better job we're going to do. And the reality is, the more deductions you're taking, you're not going to get 100% of that back. Okay, you're going to get the majority of it back, but some of it will be deemed actual business expenses. And so, my sentiment is, the year or two before a sale, try and clean it up as much as you possibly can. The other thing that we see is on the practice management software, we see production, being allocated, let's just call it all across the board, for who's actually doing services at a hospital. And when most of the companies come in, and when we come in, and when the CPA firms that are doing quality of earnings come in, they are all going to allocate to your veterinarians the production that they're doing at some percentage. That they're going to allocate salary at some percentage of production. So we see very routinely where the practice owner is the doctor that gets his production, plus all the refills, plus all the stuff that's done at the front desk, plus some boarding, plus anything that's done by a specialist. All these different things kind of are lumped under a single doctor, and you should absolutely clean that up. I can guarantee you the companies will afterwards, because most of them are going to have some type of salary system where doctors are on salary, but also will get bonused based on production, but they want to bonus them based on actual production. So you should have individual doctor production that's tracked accurately. You should have a refill doctor that gets the refills, that when it's not needed to see a veterinarian to fill it. You should have a over-the-counter doctor that may do front desk stuff or technician stuff. If you've got specialists coming in, you should have specialists. Doctors, just maybe a generic one, or you can have individual ones. If you've got relief doctors, you can have a generic relief doctor or the individual ones. But absolutely credit to whoever does the work, the appropriate information that makes it to an invoice, because this is frankly what pay scales are going to be determined for doctors when companies go to look at your practice. And so clean it up. And down the road, if you've got any earn out or any future sale based upon future profit, which is routine in joint ventures and things like that, you want to clean it up for that. In general, it is rare that we see doctors being credited with too little. They're almost always being credited with too much, and that's going to hurt your profit, and that's going to hurt anything that's tied to profit related to sale price. So those are the things that I think you can clean up on the the financial and practice management metrics. A couple other things that I would tell you, we can go over with you if we do an evaluation what your normal profitability ranges are, but there's other issues that we see all the time that are they're somewhat material. Associates tend to be, well, Associates and real estate issues tend to be the two areas where we have the most issues trying to get things closed. In general, if you've got key associates at your practice, most of the companies are going to want them to sign some type of contract going forward at the time of the sale. And it's really helpful if you've got contracts in place, existing before you go to market. And in particular, if they've got assignability clauses in them, or most definitely non-compete clauses in them. These are very valid in most states in employment contracts. Not California, and not a couple of others, but everywhere else they're valid. And so, if you have an employment contract which is assignable, that makes life really easy, because that's usually just rolled over to a new company. But telling your employees and getting them to sign new contracts and things like that, that's an area where a lot of vets have a little heartburn in doing it, and we certainly have issues that rise up in the event there's less documentation when you're trying to get contracts signed. It's an area where we pretty routinely up front tell doctors to expect some type of contribution to employee bonuses or retention bonuses or things along that line, because that's frankly where the market is right now. On your real estate, we really see two different things. If we have leased real estate with an outside landlord, we have landlord issues. And I scratch my head, because they're usually getting in a tenant that's got significantly more credit worthy than any of you. It's got bigger, deeper pockets and more assets and things like that. But they landlords sometimes are not motivated to be responsive, and we've had numerous transactions held up by landlord issues. And the other thing too is the companies also want to have some reasonable duration at a building if they're buying their practice. So they're generally going to want at least a 5 to 7 year lease there. And if you've only got 2 years left on your lease, they may want you to do a renewal or participate in it, and getting responsiveness out of a landlord is issues. And we've seen landlords hold transactions up, kind of hold the gun at your head and say, I'm not going to do anything unless you pay me some significant dollars, like hundreds of thousands of dollars. We've seen this in several circumstances. So, this is it can just be an issue, and so we like to stay on top of it. If you own the real estate, then the question is, do you want to keep it? Do you want to sell it? We don't really spend a lot of time working on that at front when we're working on your practice, only because we're focused on getting you the best possible, most bulletproof lease that we can, which translates into the lease you want if you keep it, and also translates into the lease you want if you sell the building. It's going to help you to sell the building the better your lease is. And so our whole focus when we're going through these is more than anything, let's get you a good lease, because that's going to make it a better investment property for you after you sell, and it's going to make it a better property to sell after you sell the practice. The one thing I will tell you is you have to look at this when you're doing a lease here. This is not your veterinary practice building. You're not going to own the practice. This is your piece of commercial real estate. And so you just have to be prepared to treat it like that, even though you may never have treated it like that in your whole life. This is absolutely, if you're selling and a corporate entity is then getting on the lease, it's a commercial real estate transaction. It's not a veterinary hospital transaction. And so you need to recognize what the typical terms and stuff like that is going to be. And if you've got issues with your real estate, if there's anything where, you got things that need to be cleaned up with partners or anything along that line, these are things that all need to be taken care of. So if we go into practices where there's partners, we go back to page 1, which is, what do you want to do? But we're asking everybody that, because we want to put together a transaction where everybody gets to do what they want to do. And imagine that we would have partnerships that occasionally the partners don't want to do the same thing. That's what we see. And so our whole goal in doing any of these transactions is to get you, the practice owners, in that circumstance, what you want out of a transaction. We just got to understand what it is. So I would tell you, that the structure of what we would be recommending for different situations, if you've got partners or things along that line, is going to be different based upon what everybody wants to do. It talks a little bit about tax structure, and this is really two things. make sure that you understand what the tax liability is going to be on your sale. And to do that, when we start getting letters of intent and things for our client, we generally ask you to introduce us to your CPA, and we'll send them a note and say, hey, this is what you're looking at doing on the sale of your practice. This is how it's going to be structured. Can you give us a written tax estimate on the sale? And we want it in writing because we want them to think about it. We want them to put it on paper and put all the taxes in. And we ask them to break it down into state and federal and sales tax and transfer taxes and anything, just so we can see it all. And the reason for this is twofold. Sometimes there's some things that we can do where we can come in and change things into, change it from an asset sale into a stock sale, or we put some personal goodwill in there, or any number of other things that we may tweak on what we ask for in your transaction to make it more tax friendly for you. The other thing is we also we're going to take a look at how the CPA is intending to file the taxes. And I'm not a CPA, but we've seen hundreds of these, and we know the areas that the CPAs tend to know really well, which tends to be they can do the profit and loss really well, but they may not be able to effectively do a transactional work, especially when you're selling part of a practice and rolling part of it up into private equity, or retaining a piece of it, or you've got earnouts built into it. These are all filed differently on your taxes, and they may be subject to different tax rates. And we just like to see that you got somebody that knows pretty much what they're doing. And so we ask for a breakdown of it. And that's, once we get the breakdown, we have a pretty good idea, are they up to speed? And we also can get some ideas as if we do one or two different tweaks, does it make sense for you? The one other thing that I'll at least mention on this is if you've got specific types of tax problems, like if you're a C corporation. C corporations have all kinds of tax issues. If you're a C corporation, when you get off of this call, you should send us an email. We should have a discussion. You got a bunch of things that you need to do on your transaction, or you're going to have all kinds of major tax issues. But other than that, the key is just understand it. The good thing is, in the current market, valuations are really, really high. And the bad thing is the tax check that you're going to write is also really, really high. And so, we're seeing many, many 7-digit tax checks, and nobody's happy about that. So, that's the main thing is just get your practice ready, get it cleaner, take care of business in it, and make sure that everything's working really good. If you've got contracts among different people, or leases or sales or anything like that, make them formal, not informal. Don't enter into any long-term agreements the last 2 years before you sell, lab agreements or things like that. They're going to bind you for 6 or 7 years, because you'll probably have to unwind them, which is going to cost you some money. Just try to keep things so that there's not a lot of baggage with it, and that it can be easily looked at and read, because the cleaner it is, the better valuation you're going to get. The more murky it is to be able to discern your true profit, you're not going to get part of that. It's pretty simple. If there's stuff that's questionable, they'll give you some of it, but they're not going to give you all of it. Okay. Questions?
And Gary, I'm not seeing any questions just yet, but I do have one, maybe just a topic you might want to expand on a little bit. And that is just the sort of timing for a sale with regard to financials and practice data. We kind of look at year-end data as being very, very clean. Is there another time that you can also, present, a clear picture of the practice and how it's doing?
So absolutely, the best picture comes with the year-end financials, because a lot of CPAs make adjustments in December that they apply across the year-end thing. So if we're doing practice, practice trailing 12 months through the end of September, you're not going to see necessarily those adjustments, or you're capturing the ones from the year before. So we tend to run them as many as we possibly can off of end of the year. The others will kind of run a lot of them off of mid-year financials, through June or through September, like quarterly type of things. But right now, this is prime time. I mean, we're doing a lot of stuff coming in the door right now, because the numbers we're getting right now is the cleanest we're going to see for another 12 months.
And we did just have a question come in. Really, I think you touched on it a little bit, but just about whether or not the S Corp is a clean sort of entity to sell.
Yeah, S corp is fine. You're gonna sell, and the bulk of that's going to flow through to you on a personal basis on capital gains. That's a flow through entity, and so you don't have any issues on an S corp. S corp taxation will probably be 90% or more capital gains, which is what you want. Although we will chat about that in just a minute. If some of the tax plans come through that are being proposed right now, that may be less material. So next slide. Okay, so this comes back to the question we asked at first: is your practice valuation ready? And what are we seeing on the markets today? What are the traditional valuations? What are the corporate valuations? And I'm just going to talk to you. If we get you a normalized EBITDA on the current market, if you're doing a sale to associates or sale to another veterinarian, you're going to probably be somewhere between 4 to 6 or 4 to 6.5 times earnings. Okay. That's just where the market is for those types of valuation transactions, that's what the bank will finance. That's what the lenders for the private equity will finance, but they're putting in more cash, and you're taking some equity, so they don't have to put in a lot more money than that. The corporate valuations that we're seeing now, in the low end is you're probably starting at the 5.5 or 6, but on the high end, we're seeing stuff north of 13 now. And the typical practice where you've got 3 doctors, $2 million plus of income, 400,000 plus of normalized income, normalized EBITDA, that probably should easily be 10x or more in the current market that we're seeing. And it's kind of crazy because what we're seeing in 2021 is, we thought 2020 was crazy, and it seems to be now COVID's pushed stuff up even a little bit higher. So traditional versus corporate, it's it's close to 100% difference. It doesn't tell me where to go, and we do a ton of transactions where we involve associates that want to buy in, and we can get them portions of the practice on a big practice bought at fairly traditional valuations, or where they've got some equity incentive plans or things along that line so they can participate. We've just got more ways than just buying the practice for people to participate. The normalized EBITDA, talk about who does the calculation. Frankly, everybody does the calculation. All of the companies are going to do the calculation. We're going to do one. Whoever chooses to buy you is probably going to get a CPA firm to come in and do what's called a quality of earnings report on you if you've got any size to you. They're going to do a calculation, and almost invariably every single one of them is going to be slightly different. So what we do is we're probably fairly aggressive at normalized EBITDA, and we usually come up with a number for you. And we're going to tell you that our expectation is, unless we did we missed something entirely, that you're going to end up being somewhere between 90 and 97% of what we came up with our EBITDA. And that's a little bit of a range. It usually tends to be more like 93 to 95%. But some of them are a little bit different. Depends on how much normalizing we're having to do as to how broad that range would be. But suffice it to say that every company that looks at you is going to be doing their own version of this. We try to provide lots of guidance related to this, lots of data, lots of information, because if you're trying to get things that are added back, the more information related to why it's not going to be a recurring expense, the more likely it is to get added back. So we're doing a pretty deep dive into this, and we're certainly putting it in a manner that we can justify the things that we put out there. And the companies, I think, are appreciative of this. I mean, they don't necessarily 100% agree all the time, but we're trying really hard to provide them data that is very usable and easy for them to look at and evaluate. We talked a little bit Jeff was early on price versus terms. This is the proverbial piece of it. I would tell you that more than 50% of the transactions we do don't go to the highest offer. And who knows what the highest offer is when you consider that 90% of the ones we're doing now, you're going to retain some type of interest via the joint venture or private equity investment. So you're going to be working there for 2 or 3 years, and you're going to be continuing to accrue value for the couple of years that you're working there, and you've got the investment over time. So in all of the ones we're doing now, that you've got some retained interest. I mean, it's rare that we see anything that there's any drop in value. I know we've got some metrics on the joint ventures. Most of our practices, because of increases in EBITDA and the increase in the multiple in the JV sale agreements that we do, they're up about 70% in value in 2 years when we go to sell the interest. The private equity investments that our clients have done that have gone full cycle, they're doing even better than that. They've been generally held about 3 years and are up about 300%. So when you look at price versus terms, what your current enterprise value is, what your multiple is, everybody looks at what I'm getting paid today. And you really need to look at in total, and this is truly where the financial plan comes in and helps. You need to look at what am I in total getting paid over 3 to 5 years, not just what's coming in the door today, because that absolutely can be significantly different. Next. So, and this comes back to the market. What are we seeing in the market today? The EBITDA multiples that I talked about were last year were probably 8x to 11x, probably more in the 9.5, 9.75 to 11x, and we're seeing easily the same thing this year. It does seem like COVID knocked the tar out of the markets for 3 months, shut down a whole bunch of deals. Everybody kind of didn't know what was going to occur, and then they realized that the veterinary world wasn't going to implode, that people were actually doing better, and there was just a rush to get things closed at the end of the year. And what we've seen is there's still a huge rush for people to get in here. They are aware that veterinary medicine has performed extremely well in these circumstances, that it's resilient, that the economic circumstances don't seem to influence it. And so there's more people in the market now than we've ever seen, paying multiples that are probably slightly higher than what we were seeing last year, which we thought were pretty nutty then. We're seeing these numbers. We're in the midst of putting together a couple of groups. We just finished with a couple, one in December and one in January, and we've got several companies that, for various reasons, have an interest in buying multiple. I mean, all of these companies have an interest in buying multiple practices, but when we put together groups, typically what we're able to do is get a group level multiple that's higher than an individual level one, and we can get some group terms that are better than individual terms, because we know, and the companies know, and we talk about this, that we're bringing to the table a chunk of practices that can all close in the same 4 to 8 weeks in a similar template agreement, where we're using basically the same legal docs. There's some economies of scale with it, and there's an ability to get in a fairly large amount of practices in a effectively what's one big single transaction. This makes it more efficient for the companies to get it in, and we've been doing these now since 2017, and it's been we're on group number 8 or 9. I quit counting. We're just happy to do this because you find circumstances in the market that it makes sense to take this approach, and we're certainly been very, very, very active in seeking these circumstances out and integrating with the companies and trying to put something together that works for everybody. I mean, our goal is to put transactions together that down the road, 2 years down the road, we all look back at it, both the buyer and the seller, and say, this was a good transaction. We should go do more. We're glad we did it, and we'd do it again. Which means everybody's happy, but they also, I will tell you, means everybody probably gave up a little bit of something. We do see occasionally things that are given up in transactions that people don't want to give up. And my hallmark of a good transaction is that this is one that everybody gives up a little something that hurts. That's just they're happy about a lot of things, but one or two things they probably aren't necessarily happy about it. The structure, I talked a little bit about that. We're seeing a few cash offers now, but 95% of what we're seeing now, there is some retained interest by the veterinarian. And this is really twofold. It's a retained interest in your existing hospital, which is the joint venture model, where you're basically taking an outside corporate partner, or where you are selling 75% and rolling over 25% of your money into the equity of the parent company. That's the private equity model. They're a little bit different. The JV tends to be a little bit easier to do, or to at least understand initially, because all you're doing is keeping an ownership in something you already own, and that's pretty easy because you already own it. The private equity is maybe a little bit less understood initially. So I think it's less well received as people start their discussion, but once they understand it and they get to know the companies and they generally know they're on par with all the other doctors and with the investors in the company, and that it maybe is easier done with a little bit less money than the JV, because it would be a higher cash sale, the private equity tends to be well received also in the current environment. And we've had enough clients that have done both that we have people that we plug into, you can plug in and talk to them. What we've seen is that the returns have been substantially higher in these, and the companies, as the multiples have gone higher, have required this more because it's a risk mitigation tool for them. They've just found that the practices where there's some retained interest of some type on the part of the selling doctors, that they do better. And that makes sense to me because you have some skin in the game. And so, they're happy to buy 75% knowing you're keeping 25% because they know that that practice is going to do better because you're still there. And our sentiment, we're pragmatic about it. If you're a material producer at your practice, you're going to probably have to sign a 2 or 3 year engagement agreement with whoever your buyer is. My sentiment, if you're going to be there for 2 or 3 years, it's unlikely in your practice you're going to do things very much different than you're doing them now. It's your practice. You're going to keep doing the same thing. If you're going to keep doing the same thing, why don't you continue to participate in how the practice is doing? And that you can do that through this retained ownership. And this has really supercharged the amount of dollars we've been able to put in the pocket of the different veterinarians. And so, we look at it and we've been really happy with this. And we've had a number of companies that have said, hey, we'll do cash deals, but the multiples are different. If you do JVs or private equity, the multiples go higher. And I think that's one of the things that, as this has come to be more the norm in the market, that's been one of the drivers of the higher multiples, or maybe it's the other way around. The higher multiples have made this the norm in the market. But either way, our general sentiment is this has been a good thing for our sellers because, over the 2 or 3 years they're going to be at the practice anyway, their return is higher. It's pretty simple. So, last thing I'll mention is tax implications. There is a number of, these things are going to be mostly capital gains transactions. Probably actually 95% or more is going to be capital gains. The big question is, what are capital gains rates going to do going forward? And there's a number of proposals on the table now that if you have $1 million or more of income, that the capital gains are going to be done at ordinary income. This is it's a problem for people that are selling practices. It is absolutely going to be hugely impactful. If we've got somebody that does a $5 million practice sale, that's an extra $1 million of taxes for them. So that's what's potentially coming. This has driven a lot of the people that we're working with to consider, doing sales this year. Most of the people I talk to say that's likely to not come until next year. It may not come at all. We may see some differences of opinion occur in Washington D.C. to where they don't want to go to that full degree, but they also want to raise them up higher from where they are now. The maximum capital gains rate now is 20%, and they're talking about taking it to ordinary income, which would ultimately be 39%. There may be a middle ground to where there's a tax rate that's 25, 30, 35. I don't know. I don't have the answer for that. My crystal ball says something is likely coming, and the question really is what. And that's driven a lot of people when you combine the COVID era valuations, which who knows if they'll last or not, with the potential for capital gains rates increases. It's driven a lot of people to take some chips off the table, and I can understand that. I think in any investment market, if capital gains rates are actually raised and they set a date in the future that it's going to occur, you're going to see a lot of chips being taken off the table in a lot of different asset classes. I don't care what it is. People are going to take advantage of lower rates if they know the higher ones are coming. And so I would, talk to your CPA, read your crystal ball. I don't know what, but my gut tells me is we're going to have some impact on capital gains taxes in the near term. So take a look at that, see if that's material to you. But you could work 2 more years and lose 10, 15, 20% of your additional on your sale price on capital gains tax increase. And if you lose some of the COVID premium, you could lose 1 or 2x on your multiple. And that's a pretty big difference than where things are right now. So with that,
Got a couple questions come in.
Yeah.
So first question is, how do you figure out the total practice sale if a seller retains part of the practice? And the question really is around, does the future salary or compensation, meaning participation, go into that calculation?
So that's an interesting question. In a lot of the when we see something from some of the companies where they're putting out a spreadsheet that shows the total return on a practice sale with joint ventures and stuff, we routinely see inserted in there the profit distributions while you've retained your ownership interest. We don't count that as part of your sale price. That's just continuing income because you continued to own the practice. And it is, we do pull it out and we include it in total return, but we don't include it as part of sale price. Okay, and you got to realize it's taxed different. Okay, which it may not be down the road, but right now those distributions are taxed at ordinary income, and anything that you get from sale price is taxed at capital gains. So there's probably a 100% difference in what your tax rate is on those. I think that's a portion of your total return that has a little asterisk beside it. So we can say you'll get this too, and you'll pay higher taxes on it, but it's not technically what you're selling the practice for. It's just returned to you because you continue to be an owner in the practice.
Great, Gary. Another question here. What about sole practitioners, like single doctor practices? Where do they fit into the whole corporate sales structure?
So we've sold some single doctor practices, and we see this broad group of veterinary practices that are the 1 to 2 doctor practices grossing $750,000 to $1.5 million, somewhere in that neighborhood, that is underserved by the corporate market. And what we're seeing is a fair number of companies that are starting to take interest because the bigger practices have got so competitive. They're looking at potentially taking in smaller practices and growing them. So the ones that are there with, gross income is helpful. If you're doing $1 million or more, that's going to be much more helpful. Location is helpful. If you're near other practices that are owned by a company, we may be able to tag you along as some type of tag along sale with some of those as an outpatient or something along that line. There's a whole host of things that I think are going to bloom over the next 3 to 5 years, because this is an area that's in the corporate that's underserved, and there's lots of appetite for different types of practices. We're seeing companies that are doing de novos and things like that. So I think this is one, I would say that this is one that's more likely to have a partnership model, because if you're one doctor practice, you are key. That is it. You're it. And so in those shoes, they don't want you walking out the door in a year. So I think they're more likely to have that type of model, but the companies are looking in to see how, can we grow you to be more than a one doctor practice? And so we're starting to see a lot more interest in those.
Great, thanks, Gary. I'm going to take on this next portion here. We do have a question about fees, but I'm going to kind of delay that till the end of our presentation here. Did you have anything else, Gary?
Nope, I'm good. Thanks, Jeff.
Okay. So next slide, please. So one thing that I think is important that, as Gary was mentioning, is trying to determine your valuation, your practice valuation. I just want to kind of go through the evaluation process that we offer clients. You may have seen this on our website. You can go to our website and click on evaluation and get started, but really it's just, it is no cost, no obligation. We're using this as kind of a starting point for both of us, for you to kind of find out what your practice might be worth, and for us to kind of take a look at your normalized earnings and really kind of gauge whether or not we think we can find a buyer for you. It's really a starting point for the conversation. So if anybody's interested in doing that, be more than happy to engage with you and get that done. It's not a real quick effort on your part. We do ask for a little bit of data. It's what we call a relatively shallow dive into your financials. So we do a non-disclosure agreement, which, by the way, I'd recommend you do that with anyone that you're sharing your practice data with. We'll ask for 12 months financial data, your P&L, your general ledger, and then the same 12 months matching for production reports and payroll. We can turn that around in about 2 weeks, usually, depending on our workload. And the next slide is kind of just an example of what we send to you once we finish our analysis. So this is a picture of a evaluation that we did for a clinic that is about 1.9 million in gross revenue. And I'll kind of run through the numbers here. You can kind of see what it might do for you if you're considering something like this. The net income showing there at 61,000 came off of the profit and loss statement. And then we try to get down to that normalized EBITDA, which we've been talking about here tonight, by making adjustments to your P&L, which is exactly what buyers will do. They'll make these same adjustments to get down to a normalized EBITDA number. So non-business owners' expenses, we do make an adjustment to fair market rent. We'll adjust all doctor payroll to 20% for associates and 22% for managing doctors. Any non-cash items come out. So getting down to basically what the buyer would be anticipating to be their earnings in year one, right? What are they actually paying for? So in this case, we're at 21.38% gross margin on the normalized EBITDA. And then what you'll see is when we finish your analysis, we're going to compare that gross revenue and earnings number to 5 practices just like that we've sold. So you can see the bottom rung there, the 5 layers of practices that we've sold, average right at $2 million. The average for those was a little over $526,000 in EBITDA. Average sale price for those practices, $5 million. That's really a multiple EBITDA 10.5. So as Gary mentioned, that's kind of where the market is, trending just a little bit higher in the first quarter of this year from some of the offers that we're seeing. But that'll give you a really good feel for kind of where, where we think your practice might sell, and it kind of gives you a good idea of whether or not it fits into your total financial plan. Real quick like that, I'll just really touch on our fees. We do a tiered fee structure. So the higher your gross revenue, the lower percentage that you would pay. It goes from 4% all the way to 7.5% in terms of just a commission on the amount of money that you take. As Gary mentioned, we do a lot of structured sales where you might sell 60 or 70% of your practice. You would pay us a commission only on the money that you receive. So, we're along for the ride as you begin your journey down a partnership with a new buyer. When you ultimately exit that partnership, that's when you pay us the balance of our fees. So it is something that you would need help with, most likely going down any kind of a partnership model in terms of exit strategies and calculations on the way out. So we're with you the whole way, but it is a straight commission sale.
Hey, Jeff, just a quick note on that.
Yeah.
A lot of people here probably don't realize it, but when we are doing those joint ventures, or if we've got an earn-out or stuff in place, then it's routine that you're recalculating the EBITDA again a year from now or 2 years from now, or whenever it is that you're doing this exit. And so, we're helping and assisting in that process. We're reviewing what's coming in the door a lot of times from the companies with their calculations. We've got a CPA on speed dial. It is routine. Like we just closed out a whole bunch of deals last month that we did the sales in 2018. Okay, but we're still in the middle of these transactions because they are here for so long. And so, just trying to get everybody to be aware, this is a lot of these, there's a lot of communication going back and forth between us and you, and it doesn't end at your sale, because your sale doesn't end, part of it does, but not all of it ends at the time that you initially sign all of your documents. So just giving everybody some perspective, because, we're a lot of times it's more like a several year engagement with us, not a, 6 month.
There's a question here. You can take this if you want to, but the question is really around this earnout portion here and some of these terms of sale. This is from the same person asked the question about whether or not, JV earnings or salary is part of the transaction.
Yep.
Kind of explain the difference between an earnout and sort of that portion of the
So a
sale.
JV is where you retain some and you sell some later down the road. The earnout is typically is additional purchase price based upon additional performance after the sale closes. Okay, so it's not a guaranteed thing. There's usually some hurdle that you have to hit in order to get the earnout. If you hit that hurdle, you could pay it additional dollars. So they're really looking for you to grow at some point in time down the road. And this, what's other is interesting here is you can see some differences between the multiples we got on different practices. I mean, these practices are all basically the same size, same gross. Their EBITDAs are all across the board, but you can see one we got 4.5 times gross, and another we got 2. The one that's got the multiple at 8, it's not noted here, but that was a cash one, and that one actually had an absentee owner. There was no vet that was an owner that was on site, which is why that one's lower, and that was why it was a cash deal. It didn't matter to keep, there's nobody there to put them in a JV. Okay, whereas the others, a lot of the others all were JVs, and so it kind of gives you some ideas as to some of the difference. The one that was really profitable in there was a very, very metro New York City practice that was, that was high end, let's call it. There's all kinds of things, and the earnout is just additional purchase price to be paid down the road.
Another question here, really just about our valuation. Question is, would we be willing to look at a practice that is under the 1.2 million mark, but has 2 doctors, and we absolutely would. It's, if you're in that neighborhood, it's not a hard and fast rule, but if you're this one question about a $1.1 million gross revenue with 2 docs. 2 doctors is really the sort of threshold, maybe more so than revenue, simply because of the risk, right? If there's 1 doctor and you choose to leave or something happens, there's a lot of risk on the buyer's part. So typically with 2 doctors in that range, we can get a pretty good feel for valuation and market demand.
We've had 1 doctor practices doing up to $2.5–3 million, and so when you get over $1.5 million, if you're 1 doctor, there's people who are going to take a look at you just because of your size. But first thing they're going to try and do is bring in more doctors. They may even, we've actually had to try to do that and assist in doing that before closing.
Another question, Gary, how often do you think a practice or an owner should do a evaluation?
That's a good question, and a little bit of it is, what are you doing the evaluation for? If you're doing it for sales to partners and things along that line, then you probably need to update it once every couple of years. If you're to the point where you're thinking about exit, then it's probably a good come and talk to us about an evaluation. We're not doing a true valuation for purposes of going to a lender or things along that line, because we don't need to. We're going to the corporate market. That's what we do. What we're going to get is going to be so far above what that valuation is that it's not material for us to do that valuation. So I would ask you, what is the reason that you're doing the valuation in the first place? Without a doubt, if you're contemplating a sale or you want to know if you're prepared for a sale, do it. We're going to give you some ideas to your profit margin, because if you're at 12%, we're going to absolutely tell you, you need to think hard about working on your practice for a year or 2 before you sell it, because you're not at market levels of profitability, and you're not going to get paid market levels.
In addition to that, the evaluation will give you a little bit more detail in terms of where you might, if you do have a low profit margin. Is it because of your cost of goods? Is it because of your comp and benefits, or what's out of line? Is it the real estate? It'll kind of give you a pretty good feel for what you need to be working on. Any other questions? I don't see any more coming through right now, but let me just kind of wrap up here, and if you have any more questions, feel free to shoot them over to us. Again, what can we do to help? Obviously, Ackerman Group is all about education. Please join us for the balance of this series. It's a lot of fun, and we enjoy it, and I hope you do as well. It's really about, we really feel like with the information we've got, we can share a lot and can really help you in this process. Obviously, the evaluation we can certainly help you with. If you choose to engage with us, be happy to discuss that in great detail with you. Again, we've had a lot of success here, and we are all about execution. Once we are engaged, it's not a quick process. The entire sale process typically takes about 6 months. So it doesn't happen overnight. And there's a lot of blood, sweat, and tears that goes into it as you get to the closing table. But it's all about trying to find the right fit, right terms, and right price for you as the seller. So as we said, it's not all about price. Our phone number's there. Feel free to reach out to us. Reach out to us by email. Gary, any closing comments?
Nope, that's good. Looking forward to this whole series. I think it's going to be a good series, and good information for anybody, no matter where you are in the process.
Great. Thanks, Gary.